Good afternoon, everyone, and thank you for joining us here today. My name's Tom Ahola. I am an advisor and realtor here at Marshall Reddick Real Estate. I'm joined by Dino Champagne, a close friend and a trusted confidant, so to say, in the 1031 world. She's helped many clients of mine. So, yeah, welcome, Dino. Welcome, everyone.
Thank you. Thank you, Thomas.
Yeah. So again, thanks for taking time out of your busy schedules. I know if you're asking questions about 1031 exchanges, you probably already own some real estate. So we're going to answer any and all questions that you might have for us. Also, just to let you know, during the presentation, we're not going to stop and pause and answer the questions now, but please still write those questions down in the chat box, and that will give us a time to go back and get those questions answered, and I'll give you a follow-up call or email and get those answers to you. So without further ado, let's get started. A little bit about Marshall Reddick as a company. We're a real estate brokerage, private money lender, property manager, and we also have the fund, the investment fund. We pretty much do it all when it comes to investment real estate. We make it possible to purchase residential real estate in carefully selected areas of the United States. Our organization provides real estate brokers, contractors, property managers, and access to top resources such as lenders, CPAs, insurance agents, attorneys, and 1031 accommodators. So we are pretty much the one-stop shop when it comes to anything real estate investment. That sounds exactly what it sounds like. A lot of people try to build a team, but we've already got the whole team in-house. So if you have any questions regarding anything about anything to do with investment real estate, give us a call. And a little bit about myself, put a face to the voice. My name's Tom Ahola. I'm an advisor here. Been here for quite a few years now. Really enjoy assisting clients with acquiring properties. I come from a family of teachers, so education was kind of ingrained in my psyche as a young person, and it really shows with helping people get educated and really make smart investment choices when it comes to owning residential investment real estate. Of course, I'm a licensed California realtor, but as an advisor, I also assist clients in state and out of state with single family as well as multifamily transactions. Personally, I mostly specialize in the multifamily stuff here locally in the Orange County and LA market, but I've got a lot of experience when it comes to a pretty much single family, multifamily anywhere in the continental US. All right, and without further ado, we'll step right into it. A lot of people ask me, what does it look like if you're going to give us a call, or what we're really going to accomplish with working with one of the advisors here at Marshall Reddick? And it really comes down to a simple chart, what you see right in front of you. We've got the why, which is goal setting. So, give us a call, we'll schedule a consultation, we'll figure it out what exactly it is. A lot of people come to us and say, for like this specific situation, I just inherited a property, an investment property my parents have owned forever. Or I've owned an investment property that I bought 10 years ago, and for whatever reason, it's got a couple $100,000 in equity now. But I'm looking to move that equity and transfer it over, or, hey, I've got a self-directed IRA, I'm just retiring, or I'm looking to buy my first investment property. We help you set those goals and figure out exactly what it is and where you want to be. The second step is how. We evaluate the options. We look and see, we really go into a deep dive of your financial situation with your assets and your real estate and help you really strategize what's going to be the best solution for getting to your financial goals. So we look at the how, are we going to pull from self-directed? Are we going to, use some equity from an investment property already owned? We just help you figure it out. When is a very important question. That's one that I like very much so, is when do you want to hit your goals? For some people, it's, hey, I retire in 4 years. For other people, it's as soon as possible. So asking those questions and helping you find out when that's achievable is very important. The what, whether you want to invest here locally or you want to invest out of state, single family, multifamily, whatever space you're really looking for, we help you figure that out. Where, that's a huge question for us as well, especially considering we operate in multiple different states. And who is last but not least, we connect you to all the key players be it a local agent, a 1031 accommodator, a lender, anybody that you're going to need to help you on this journey. Here's a short, short description of the states that we operate in. Pretty much any state that's dark on the map. Now, we do deals in some of these states, but the main states that we do business in will be California, which is Bay Area, Los Angeles, Orange County, Riverside, and San Diego. So we pretty much stretch all the way up and down the coast of California. Fort Myers, Florida, Clarksville, Tennessee, Nashville, Tennessee, Austin, Texas, San Antonio, Texas, as well as New Braunfels. Those are the places where we have offices with property managers and brokers and lenders and all in-house Marshall Reddick staff to help you with your real estate journey. However, that doesn't change us from being able to help you 1031 into one of these states. Dino personally has worked with multiple clients of mine. I know one in Boise, some in Arizona, a couple other states, pretty much anywhere in the continental US. We can help orchestrate a 1031 transaction if you wanted to move your assets into one of our Marshall Reddick performing markets. All right, and a lot of people ask, why do we invest in these places? This is like the first question I get asked from people when they want to schedule a consultation. Hey, what do you think about, random city, Ohio? Well, there's a reason why we've chosen the cities that we chose, and here is why. We don't just pick small towns where the, cash on cash looks great, but the numbers are completely inflated. We actually do markets where we have done full research into these areas. We actually do market data packets, which if you are curious in any of the markets, reach out to me and I can send you one of the market data packets. But pretty much the market data packet will have all of this information on there. Why we choose to invest in this market. Number one is job market. We look at places that have a lot of job diversity. We're not looking for a place that has just one giant manufacturing plant. No, we want a place that has a ton of industry flowing in and growing and changing. That means medical, tech, manufacturing, education. Look at San Antonio for that purpose. That's one of our favorite places for a lot of investors. Same as Clarksville, Tennessee. Not just that, but the military bases. So we look for places that have pretty much the full scope of something so that if a recession were to hit, the town isn't going to go down as normal, like if you were in a place where there was a giant manufacturing plant and that plant left. That's number one reason. Number two, vacancy rate. We look at statistics and charts and find markets that have extremely low vacancy rates. Why is that important? Because an extra month of vacancy could be your year's profits. We also look for economic diversity. That kind of ties right into the job market, but also plays into everything else that's going on with different career opportunities, different options. We look for housing affordability, not just for you as the investor to be able to afford to purchase the asset, but also an area where the quality of living is a little bit higher because their cost of expense is a little lower. So, average sales price here in my neighborhood in Southern California, you're looking about 1.8 million. Some of these other markets that we operate in, you're looking at like 250 to 300,000 for a single family, sometimes 400 or 500K for a duplex. So much different purchase price. I'd almost say a quarter of what I see here locally, which is also a great tool to have when you can help investors acquire assets at that lower purchase price. Number five, if anybody of you here lives in Southern California or owns real estate in Southern California, landlord friendly, big question mark. California just did put in the statewide, tenants' rights, and it's tricky. It's people learn how to dig their heels in and really game the system. We like to invest in states that are a lot more landlord friendly. If somebody stops paying their rent, they can't dig their heels in and squat in your house for 8 months. We also look into these markets where we're very strongly educated. Again, I was talking about those market data packets. The reason why we chose these markets, the reason why we stay in these markets is because it's what we know, it's what we trust, and it's what has performed for our clients over the past 40 years. Also, last but not least, reliable property management. Tying back into number two, vacancy rate. Property managers have a huge deal with your vacancy or the maintenance or the overall NOI of your property. Reliable property management is worth more than buying the good deal itself. So not only can we help you find the deal, but then we manage your asset afterwards and help you keep it performing where it should be. Another reason why a lot of people 1031, they've got an asset in a place far off spot. The manager is not managing effectively, and it might be a good deal when they bought it, but sometimes it's better to just move your assets into a better performing state or a better performing property with a better performing property manager. And here to help us with that is Dino. All right, Dino, take it away.
I shall. All right, good afternoon, everyone, or almost evening. As you know, my name is Dino Champagne. Let me tell you a little bit about who we are as a 1031 company, and I'll give you a little bit of background for me. Asset Preservation is a national 1031 qualified intermediary. As a company, we have facilitated over 200,000 exchanges since 1990. We're owned by a large title company, so you have financial backing of a large company. I have been with the company for 20 years now, and actually for that period, I have helped a lot of the Marshall Reddick investors do their 1031. So I'm very familiar with the Marshall Reddick group as well. All right, so what I'm going to cover this afternoon is going to be, hang on a second, we always have that little handoff issue with the give me a second. There we go. Okay. What I'm going to cover is going to talk about what capital gain rates are, IRC section 1031, because it is actually a part of the tax code. Going to go through what like-kind property is, the exchange equation, the delayed exchange process, and the identification rules. And in the end, I'm going to go over some tips that I find that are very helpful to have a successful 1031 transaction. What I'm going to cover is not going to cover every aspect of a 1031, and I may not cover everything that may arise in a transaction, but I'm just giving you like the bigger picture. I'll try to drill down when I can to give you a little more insight into different aspects of this. So let's just start off with why people do a 1031. So the thing that's important to understand is when you own investment real estate and you decide that you want to sell the real estate, there are 4 potential taxes that an investor is going to be faced with. First tax is going to be the recapture tax. When you own investment real estate, you've been depreciating that property over the course of the ownership. So that lowers your real estate taxable income while you're operating the property. But when you go to sell the property, there's going to be a tax associated with that figure. So that tax rate is at 25%. And then you have federal capital gain rates. Now, the federal capital gain rates right now, we have 2 different rates. There's 15% and there's 20%. If a taxpayer is single and their income is more than $459,751, I know that sounds weird, but they have a cost of living index. So every year that number changes. But if you're a single taxpayer and the income is more than $459,751, you're going to be in the 20% tax bracket. If you're a married couple and the income is more than $517,201, the 20% tax bracket. Anything below that is going to be at the 15%. Now, selling real estate could throw you into a higher tax bracket, so just be aware of that. And then there's the third tax at the federal level, which is called the net investment income tax. When I say the net investment income tax, if I use the term Obamacare tax, people understand what it is a little bit clearer. That's an additional tax of 3.8%. So if a single taxpayer is selling a property and the income is more than $200,000, or a married couple, $250,000, you're going to be subject to an additional 3.8%. So as you can see at the federal level, you've got recapture tax, 25%, capital gain tax, 15 or 20%, and then the net investment income tax at 3.8%. Then if you're in the state of California, your tax can range anywhere from 9.3 to as high as 13.3. So when an investor is selling an investment piece of property, these are the taxes that they're going to be faced with. When you think about the tax liability, if I give you an example saying that an investor has sold property and the gain on the sale of that property was say $720,000, just to use that number, that particular tax payer would be potentially subject to roughly $255,000 in taxes. So the beauty of having investment property is that you have a tax code that can help shield you from paying those taxes. So in other words, you get to defer the tax on the sale of the property. Now, like in any transaction, there's always going to be pros and cons. So let's talk about the pros of doing a 1031. Well, one, you get to, like I said, defer the tax on the recapture, the capital gain rates, the net investment income tax, and the state income tax. Majority of the states do comply with the 1031 code. California is definitely one that does. Pennsylvania actually is going to be joining the deferral of 10 for any properties out of Pennsylvania effective 2023. That was one of the states that did not allow for any deferral of the state income tax. Okay, so the pros, I get to defer the tax. Another advantage to a 1031 is I get to build my wealth as an investor. So in other words, I'm preserving my equity. Instead of me having to pay the IRS and the Franchise Tax Board being in California, I get to take that money and I get to go off and buy more property. I can utilize leverage. So sometimes an investor might be in a position where they either have a very small loan on the property they're selling, or they may have no loan on the property they're selling, and they want to build their wealth by going out and buying more property and doing that through a vehicle, by financing. So that's an advantage of a 1031. I get to diversify. I can diversify geographically. I can diversify by asset class. We're seeing a lot of people, like Thomas was talking about, you've got landlord. It's a little more landlord restrictive here in California. So somebody may sell a high appreciated property in California and go buy multiple properties in states that are a little more landlord friendly. So I get to diversify geographically and also by asset class. And I'm go into like kind of property, you can see that the array is quite large. And then another advantage to doing a 1031 is where people might be utilizing this tax code for estate planning purposes. So under current tax law, if an investor exchanges and passes away, then their heirs, when they inherit the property, the taxes, the capital gain taxes that the taxpayer that was deferring it is not passed on to their heirs. So they get a step up in basis. Now, notice I said under current tax law. You always have to keep your pulse, your hand on the pulse of this because you don't know what Congress is going to do. But people do utilize 1031s as an estate planning opportunity. Now, with every pro, there's going to be cons. So let's talk about the negatives of doing a 1031. Well, one, there's these pesky rules and restrictions. Okay, we're going to go through that. You're going to understand that these timelines are real, they're statutory, and they can be very restrictive. Another downside to a 1031 is that the replacement property basis moves with you, so it's lower. So when you think about somebody selling an investment property, and they figure that the relinquished property has a basis in it, right? And that's what you originally paid for the property, minus the depreciation plus any capital improvements. So that number is used to calculate gain. So if I have a property and my basis is, say, $300,000, and I'm selling it for $600,000, and I buy a new property in an exchange for $600,000, my basis in the new property is not what I paid for it. It's what I paid for it minus the gain deferred, which would have been $300,000. So that's one of the downsides with the 1031 is your old basis is moving with you to the new property. If you buy higher than what you sold for, then you're adding to your basis. So again, one of the restrictions to a 1031. The other would be lack of liquidity. What I mean by that is when you're doing a 1031, any cash you would keep would be taxed. So you're having to put all the money coming out of the exchange into a new property. All right, so just be aware of that. If you have any losses, if you don't consult your tax advisor prior to the transaction, you may end up doing an exchange and you had losses that you could have used against a gain. So once you've done the transaction, you can't recognize the losses on that transaction. So always important to consult your tax advisor when you're considering selling investment property. Then there's the obvious one, possible risk of higher taxes in the future. And again, 1031s are tax deferred. They are not tax free. Okay. So, but we do actually have this opportunity to defer the tax through this tax code itself. All right. So now there are going to be 4 basic guidelines to a 1031. The first is going to be the property qualification. So when you're selling investment real estate, that qualifies for a 1031. So it must be real property that was held for trade or business or for investment. Okay, so that's your first basic requirement. Does the property itself qualify based on what it is? All right, the next guideline is going to be how much you have to spend. So the government says that in order to defer the tax on the gain of the sale of the property, you must purchase property or properties, so you can do multiple, equal to or greater than your sale price minus the closing cost. You must spend all of the cash, and you must replace any existing debt that you had on the relinquished property in order to defer the gain. When you think of a 1031 in this particular guideline, just think of it as a continuation of ownership, although it's with a different property in a different location. Now, the third guideline is the timeline, the hard part to the exchange. So when a taxpayer is doing an exchange, they have 45 calendar days to identify. And then they have, I like to say, an additional 135 days to complete the exchange. So the exchange period from beginning to end is 180 calendar days. And the fourth basic guideline is going to be the identification. So you have to identify the property or properties that you would like to purchase in the exchange. So we're going to go through each and every one of these so you get a better feel for what the flow of a 1031 transaction is going to look like. All right, so let's talk about the like-kind property. If you've been an investor for a while and you've heard about 1031s, you've heard the term like-kind property. Well, people sometimes still think like-kind means duplex for duplex, or farmland for farmland, or office building for office building. And that's not the case. When you think of a 1031, just think of a 1031 as investment real estate for investment real estate. So it allows the investor to move around with different types of asset classes, like I described earlier, right? One of the advantages to doing a 1031. So if I'm going from, say, raw land that I've held for 10 or 15 years for future appreciation, well, we know raw land generally is not giving me any income. So now I want to, but it's appreciated over time. So now when I sell that raw land that I held for investment purposes, I can go off and I can buy an apartment building, or I can buy a single tenant triple net. You know, I can go from an industrial building to, you know, to an apartment building. I can go from a retail shopping center, you know, to single family rental. So you can see there's a lot of latitude when we talk about like-kind property in the 1031. So let's talk about what does not qualify as like-kind property. Well, one, that would be your principal residence. So if you're living in the property and it's all it is your primary residence, then that doesn't qualify for a 1031. And I know this sounds kind of silly to have that topic that be discussing principal residences with a 1031, but there are a lot of times where people have owned their primary residence for a really long period of time. Now they're going to sell it. Well, under the primary residence tax code, you have exclusion of gain of $250 if you're single, $500,000 if you're a married couple. It's not uncommon for people in Southern California to have their gain on the sale of their principal residence exceed that exclusion. So they're hopeful that, oh, well, if I sell my primary residence and my gain exceeds the exclusion, I can do a 1031, right? No, you can't. A primary residence is a completely different tax code, so that doesn't qualify for a 1031. So I can't sell my principal residence in a 1031, nor can I buy a property that I intend to occupy immediately in a 1031. Another type of property that people sometimes get confused with and think might qualify for a 1031 is property that's held for sale. So in other words, think of a fix and flip. If I buy a piece of property, I fix it up, I turn around and I want to sell it. Well, maybe in my mind, I'm thinking, oh, that's an investment for me. But under the tax code, it's not. It's considered inventory. So therefore, it does not qualify for a 1031. So those are the two types of properties that if you're living in it, it's a primary residence, doesn't qualify for a 1031. And if you're a build and sell, fix and flip, does not qualify for a 1031. So just keep in mind, for qualifying property in a 1031, it must be property that's held for trade or business or for investment. It's got to be real estate, real property. Okay. Now, when they talk about, well, hold for investment, well, what does that mean? How long am I supposed to hold the property for to be declared held for investment? Well, there's nothing in the tax code that mandates a specific holding period. So there's a couple of ways that tax advisors might look at this. Some tax advisors may be more conservative and they'll say, well, we think you should hold this property for a minimum of 24 months because we think that that would help establish that you held the property for investment purposes. There's private letter rulings in regards to some of this, but there was also a revenue procedure that came out in 2008 that addressed second homes and vacation homes in 1031s. In that revenue procedure, it said that they must own the dwelling unit for at least 2 years. So you can maybe look, say 2 years might be sufficient. Then there's some tax advisors that might be a little bit more aggressive and they say, well, no, at least 12 months because it'll cover at least 2 tax returns. If you held an asset that's an investment for more than a year, you're now under long-term capital gain rates. So that's another indicator that maybe a year is sufficient. But the reality is there's really nothing in the code that says how long you must hold it. That's going to be a decision between the investor and whoever's advising them on their taxes to determine, did you hold that property for investment purposes? Can you substantiate that intent? Okay, so just keep that in mind. All right, now let's talk about the next qualification for the 1031, what we call the exchange equation. So how much do you have to spend? So here's an example. If I'm selling a property for $900,000 and the loan on the sale of that property at the time it was closing was $300,000, there's going to be some closing costs, right? So let's just say in this example it's $60,000. That means the cash coming out into the exchange is $540,000. If I buy replacement property of 1.2 million and I spend all of my cash, now I'm getting, and I've replaced my loan. So this is an example of where leverage comes in because I'm utilizing leverage to buy a higher valued property. So in this example here, I would have no tax liability. There's no boot. So when you hear the term boot, all that word means is taxable. Then I've met the goal of the exchange. Now, there are some instances where people might decide, well, maybe I don't want to buy as much. Maybe I want to keep some cash. Now, I'm going to give you an example here that's going to show you 2 types of boot in a 1031. One's very clear when it's cash boot. In other words, you didn't spend all the cash. But the other one is a little bit more hidden, if you will, because you didn't, in this example, they didn't replace the debt. So there's mortgage boot. So sold for 900, got loan paid off of 300, closing cost 60, 540,000 came in. Bought a new property for 700,000. Automatically, you can tell that that's going to be a taxable event unless the investor is buying another piece of property. But we're saying they're not in this example. Okay, did not spend all of the cash, right? So they only put 440 down. 100,000 of the cash was not spent. But what else happened? The mortgage was only 260. All right, so they didn't replace the full $300,000 mortgage. Now, I know this is like a silly example, but you see, when you don't replace the debt, that becomes a taxable event. It's, I see it more where people go, well, I don't want to have any debt on the property that I'm buying. Well, that's fine as long as you're prepared to pay the tax on the mortgage boot. So you just have to be aware that when you're doing a partial exchange, what your tax liability is going to be. Also, something to consider when you're considering a partial exchange is that if you're keeping too much out of the exchange, so in other words, you're not reinvesting enough of the for the exchange, are you still going to benefit? So here's how I like to describe that. If the boot, remember boot just means taxable, is either equal to or greater than your gain on the sale of the property, then there's no benefit to doing the exchange. So for example, if the gain on the sale of this property were 100,000, okay, that's your difference between your sale price and your adjusted basis, and the boot is 140,000, this taxpayer would pay tax on the 100,000 like nothing happened. So they wouldn't benefit from the exchange. Now, if the gain on the sale of the property was $300,000 and the boot is 140, then the taxpayer still benefits from the exchange because they're protecting tax on the other 160,000. So the long and the short of it in this discussion here for this moment is that if you're going to do a partial exchange, make sure you understand how much gain you have on the sale of the property, and will you still be benefiting from the exchange by the value that you plan to replace it with, okay? Again, very important to have this discussion because you want to make sure that you're still benefiting from the transaction. Now, here's something that comes up that's important for people to understand if they're focused on the wrong items. People sometimes they zero in, okay, I have to buy higher than what I sold for, right? So sold for 900,000, this particular property is $1.1 million. So that's going in the right direction. Well, here's where the problem is. Remember, you must spend all of the cash. So in this example here, even though the investor bought higher than what they sold for, they got a larger loan on the property, and therefore not utilizing all the cash. That 140,000 is now going to be taxable, even though they bought higher. So you want to be very careful that when you're buying replacement property, you understand how much debt you have to replace, and you're with your lender to make sure that you're putting down the right amount of money for this transaction. Obviously, had they put the full 540 down, and got the loan for the difference, they would have met the exchange criteria. All right. So again, be careful of making sure that you're meeting the criteria, not only just buying higher, but also spending all of the cash. That's a part of the 1031. Now, let's talk about closing costs, because there's certain items that are considered acceptable exchange expenses, and there are items that are not. All right, so let's talk about what is acceptable. Well, the real estate commission, paying any title insurance premiums, paying the escrow fees or the closing attorney fees, any legal fees associated with the transaction, transfer tax, notary fees, recording fees, the qualified intermediaries fees. Those are all costs of transferring the property. So they're considered acceptable exchange expenses. Now, you might have some cost into the transaction that you might think qualify, but they really don't, because they're not a cost of transferring the property. So here are some examples. Prorated rents and security deposits. For example, if you're selling an apartment building, it's not going to be uncommon, it's probably going to be real life, that the prorated rents and the security deposits for the tenants are going to be transferred over to the buyer, right? So there are a lot of times where I see the real estate professionals are negotiating this, and they're going, okay, well, the seller will credit the buyer with the prorated rents and security deposits. Well, the problem with that in a 1031 means that if you're crediting the buyer, so let's just say for $20,000, that means $20,000 is not coming into the exchange, and therefore those credits for the prorated rents and security deposits are going to be taxable. So there's ways of dealing with that in a 1031, such as the seller would be bringing in the security deposits, and then they transfer it over to the buyer. So you just have to watch what you're doing in these situations. Another cost of doing a 1031 that people think is a part of transferring would be lender fees, but it's not. Lender fees are cost of buying financing, not a cost of transferring or buying the property. So if there's points, prepayment penalties, anything of that nature, okay, yield maintenance, that's all a finance issue that's not a cost of transferring the property and would be subject to tax. Paying the buyer's closing costs, not uncommon to see in transactions where in some cases where they're going, okay, I'm going to pay for the buyer's closing costs. Well, if you're paying for the buyer's closing costs, that's potentially subject to tax. How your accountant deals with that when they file your tax returns, that's between you and the accountant. It's just important to understand that that's a potential for the tax liability for a 1031. And then paying the lender title policy. Impounds, see a lot of that where people have to get impounds of property taxes and insurance. Well, you cannot be using exchange proceeds for impounds, because impounds is another cost of operating the property, not a cost of transferring the property. So as you can see, there's items that are going to be a part of a transaction that could be subject to tax. So it's really important to make sure that your accountant is reviewing these closing statements with you, all right, when you're dealing with this. All right, now let's get into how the transaction works itself. So now you decide as an investor, it's time to sell that property. Highly recommend that when you're getting ready to list that property for sale, that you talk to your tax advisor to determine, do you need to do a 1031 based on your tax situation? Sometimes you may not have to do one because you may have some loss carry forwards that can be utilized against the gain on the sale of the property. You want to know this because if you don't need to do a 1031, then you don't want to do one. You can sell the property and you can take your time about buying the replacement property. You're not in that timeline, which we're going to discuss. So now you get your property, you've talked to your accountant, you decide whether you're going to do the exchange or not. You have a buyer for the property, you open up escrow. That's when the qualified intermediary, that's when my role is now going to officially begin. Okay, I have to have a contract that I'm going to be assigned into because I become the seller of your property. Now, don't panic. I have absolutely nothing to do with any of the terms or conditions that have been negotiated between the parties. We're just merely there as a qualified intermediary. Okay, we're just merely there to facilitate the exchange. So we have to prepare exchange documents. So when you're in a real estate transaction, you're going to have your listing agreements, you're going to have your purchase and sale negotiations going up and back. When you open up escrow, you're going to have all the escrow documents that are coming in with the escrow. And then now you're going to have another set of documents for the exchange. All of our documents are very critical to each phase of what you're doing, but you must have the exchange documents prepared and signed before the closing of that sale. You cannot set up an exchange after your sale has closed. So let me repeat that. You cannot set up an exchange after your sale has closed. So just be advised that when you open up escrow, that's when you start putting the exchange in place. Now, the buyer comes in, they bring in their money. The deed to the property is going to go directly to the buyer. The money is now coming to the qualified intermediary. Now the time frame for the exchange is going to officially begin. So this is where the 45 and 180 calendar days start. It does not start when you get in contract. It does not start when you list the property. It starts the day the sale closes. In the state of California, that's the recordation of the deed, okay? So 45 calendar days, 180 calendar days begins. Now, you go out and you find your replacement property, and I'm going to come back to the time frame in a minute, but you go out and find your replacement property. Then we have to prepare the exchange documents for the buy side because we as the qualified intermediary become the buyer of your new property. Again, we're not going to be going on title. So you sign the replacement property exchange documents. When you're ready to close, we wire in the funds, and then the deed to the property goes directly to the taxpayer doing the exchange. So as you can see, that's how the flow of the exchange works. So the qualified intermediary becomes the seller for the relinquished property. We become the buyer for the replacement property. And that's how the exchange is facilitated. We do not go on title to anything in a forward exchange. Now, let's talk about the identification period because that's the critical part to doing the exchange, because you have to identify what you're going to buy. And this part can get very challenging, especially in low inventory, in a low inventory market, which we've been experiencing for the last 2.5 years. That seems to be shifting a little bit, but it's still somewhat of a seller's market, okay? So when you're a seller in a seller's market, it's always nice, right? But now you're going to be a buyer in a seller's market. So the challenge for the 1031 can get a little bit, more rigorous, if you will. Okay, so there are 3 identification rules. You can only use one of the 3. The first rule, which is the most commonly used rule, is the 3 property rule. So the taxpayer is limited to 3 addresses, but they're not limited to dollar amount. So if I sold for $900,000, I could list a property that I'm identifying, say, for $1.2 million. I can list another property on my list for $1 million. I can list a third on my list for $1.7 million. All right, buy whichever one or 2, or if I wanted to buy all 3, not a problem. But if I wanted to identify 4 or more addresses, now the dollar amounts of those properties are going to come into play, because now I'm outside of the 3 property rule and I have defaulted now to the next rule, which is the 200% rule. Under the 200% rule, I can physically list 4 or more addresses, but the fair market values of each and every one of those addresses that I list cannot exceed 200% or 2 times my sale price. So if my sale price was $900,000, I could list 5 or 6 properties. But when I add them up, those values cannot exceed 1.8 million. And I just need to buy whatever combination I want to meet my minimum exchange requirement. Now, if I identified 4 or more addresses, but the values exceeded 2 times my sale price, now I'm into the third and final rule, which is known as the 95% rule. Under the 95% rule, I can identify, like I said, 4 or more, but I'm not capped at 2 times the sale price. So basically, the sky's the limit. But before you start thinking that's a great idea, you must close on 95% of the total aggregate value of all the properties identified in order to qualify. So basically, under the 95% rule, you would have to close on every property you have identified. So you definitely want to stay out of that rule unless you feel extremely confident that you're going to be able to be successful in the 1031. So when I'm talking to people and they go, well, how many properties can I buy? Well, you can buy as many as you want, but now which identification rule are you going to be able to use to have a successful exchange? So if somebody's selling a property, say, for $400,000, and they're buying properties that are going to be in the same area, maybe with the same price point, to me, they're going to be in the 3 property rule. They're not going to be able to utilize the other 2 rules because the values are not there. Now, if I sell a property, say, for example, in Orange County for $1.5 million, but I'm buying single family rentals, say in Tennessee or in Florida, where you can get properties in the $200,000 range, then at that point, I may be able to use the 200% rule because I can buy a lot more properties. It still stayed within that $3 million because I sold for $1.5 million. So it's going to get really important to determine when you're thinking about your investment strategies, which identification rule, how much property you wish to purchase. It's important to understand you still have to match these identification rules. All right, so while sometimes people like to leverage to the hilt, I had like one lady, she really wanted to leverage everything, but she would have been in the 95% rule. So she had to tone it down a little bit, get finished with her exchange, and then at a later date, go off and finish what she might have wanted to do. Okay, now to identify, it's not about being in contract. That's part of it because you want to be in contract when you're getting ready to do the identification, but it's an actual form that you're going to fill out. So it must be in writing, unambiguously described, sent by midnight of the 45th day, okay, to the qualified intermediary or somebody related to the transaction. So here's what an identification form looks like with us. It's a form you're going to fill out, right? So that form generally is going to come in as you get closer to the 45th day, because in the meantime, you're going to be making offers on properties. Some not going to get accepted, some are going to get accepted, right? So you get these properties accepted, you get into contract. And what if it falls out? Well, if it falls out and you're still within the 45 days, then you're probably not going to put that property on your list. But by being in contract solely, that is not the identification. So sometimes people get confident and go, well, I've already got my property in contract, I'm in escrow, and I'm going to close on this property. You still must fill out the identification form, okay? So it's a statutory thing for the exchange, and it's a critical thing for the exchange. You must fill out the identification form in order to qualify as like-kind property in a 1031, okay? So just understand that this is very important to a 1031. And the other thing to make very clear, you can only purchase the property or properties that are on that list. You cannot change your list after the 45th day. Again, the tough part to the exchange. All right, now let's talk about, sometimes people are trying to consolidate. So here's just a quick example. If somebody's trying to sell, say, maybe 3 single family rentals and they maybe want to buy 5 units. So when you're doing a multiple property exchange, that means you're consolidating, right? You're trying to sell the 3 to buy the 1. The challenge with this type of an exchange is that the time frame for the exchange, so the 45 and 180 days, is going to start at the closing of the first property. So you want to make sure that if you're trying to accomplish this type of transaction, that properties 2 and 3 are going to close as close as they can to property 1, because that way you feel confident that you're going to be able to accomplish this in the 1031. It's not always easy to do, okay? But if you get it done, you go off and you buy the new property, it works. What we see majority of the time is this: you sell one property and you're going off and you're buying multiple properties. The thing you remember is that you have to complete your exchange by the 180th day. So they don't all have to close at the same time when you're purchasing, but you have to identify the properties you're going to buy, and you have to finish that last purchase before the 180th calendar day. So when you're doing multiple property exchanges, be cognizant of the time frames for these transactions. All right. Now, I'm going to go over what I like to say as my 5 tips to help for a successful exchange. One of the first ones that I think is so critical is to make sure that you're consulting with your CPA or your tax advisor when you're getting ready to list the property. Hopefully you have a tax advisor that understands real estate in 1031s, because they're going to be an integral part for your success in this kind of transaction. You want to talk to them about, do I need to do an exchange based on my tax situation? You want your tax advisor reviewing these closing statements, because we as a qualified intermediary, while people look to us for a lot of guidance, there's certain things that we cannot do. And one of the things that we cannot do, and that's give tax advice. So your tax advisor is the one that's giving the tax advice. They're the one telling you, did you hold it long enough for it to be declared for investment? Or they're reviewing those closing statements and they go, don't worry about this, we'll be able to offset that. So they're reviewing these closing statements. Very important to make sure that your tax advisor is somebody that you're dealing with early on in the transaction. The next thing is going to be to have a conversation with the qualified intermediary, also known as accommodator, because we're going to have a different conversation with you. We're going to talk about the rules and the guidelines, very similar to what I just got finished doing. Going to take you through the process, going to answer your questions about your specific transaction, what's going on in the transaction. Going to go over the steps, give you an idea of what to expect in the transaction. So I'll say, okay, for example, I need the exchange needs to be set up. I need to communicate with your escrow officer. Now, sometimes people will go, oh, well, I haven't found my replacement property. If you don't set up the exchange on your sale, finding the replacement property is not going to matter. You have to set up the exchange with your sale side of things. So I'm going to take you through the steps. You're going to get documents from us. You need to sign those documents. Do not ignore emails. I mean, this is kind of the conversation we have, so what to expect in the transaction. So I'm giving you an idea. This is what's coming. Okay. The next is going to be, that's important for you to familiarize yourself and get a little more ingrained about the processing of the exchange, the time frame. Remember how much time you have. All right, sometimes people forget. I always get nervous when somebody says, oh yeah, I'm just getting ready to close, but I'm going on vacation for the next 30 days. Remember that 45 days is not stopping for you if you're, if you're on the, if you're visiting the wineries in Tuscany somewhere. All right, it's still going at this point. So understand your time frame. Understand what you need for full tax deferral. I think it's also very important for you to understand the lending environment that we're in, because if you're replacing debt on a property, you want to make sure that you're not going to have any hiccups, if you will, with the financing aspect of that. We as a qualified intermediary, we're not the lender. All right, but you're going to want to make sure that you're dealing with your lender to understand what you have to meet. Are you going to meet these loan requirements for them? So stay engaged in that regard. So be familiar with the time frame, know how much money you have to spend, be engaged with your lender. The next one is, I see this way too often, and that's confirming your tax ownership to the vesting of how you're currently holding title to the property you're about to sell. It's not uncommon for people that have bought property a long time ago and they've changed their tax ownership or they got married, but they never changed the vesting on the property that they're selling. So when you're doing a 1031, you want to make sure that your vesting, so how you're on title to the property you're selling, is actually matching how you've been reporting the property. So it's important to consult your tax advisor. I've seen situations where a husband and wife have bought property. They decided during this ownership that it was better for them to, have this property treated as in a partnership, but they never bothered to change the vesting. So they created their partnership, but they never changed title. Now they go to sell the property. Who's my exchanger? Susie and Paul or the S&P LLC? Well, it's the S&P LLC if it's the partnership. So now you have tax ownership out of sync with vesting. So it's really important to make sure that when you're getting to the listing stage of your property, that you're looking to make sure that the tax ownership is actually matching the vesting. That does, because it creates a lot of issues in an exchange when all of this is trying to happen at the closing or as they're getting close to the closing of the sale. And if you're in doubt about anything, who do you consult? Your tax advisor. How have you been reporting the property on your tax returns? Does it match the way the title is on the property? And then the fifth one, communication. Like anything, the more communicative you are, the more proactive you are in your transaction, the more success you're going to have. Knowing the timeline, staying engaged in your own transaction. I mean, there's times where people set up an exchange and they're looking to everybody else to do all the work. Well, you have to understand it's your transaction. You're the one that's facilitating the exchange. So, you want to be engaged, you want to communicate, and you really want to make sure that you're answering and asking all the questions that you need to ask, to the right parties. If you have 1031 questions about the process or the timelines, don't go to your neighbor unless your neighbor's your qualified intermediary. You want to go to your qualified intermediary and ask these questions. I will tell you, people will consult other people about 1031s, and the information that they get is extremely costly because they're not consulting the right people. So be proactive in your transaction. And if you forget the stuff, if you can't remember everything, don't worry. I mean, this is not what you do as a daily job, right? So do not hesitate to ask if you have questions about your transaction. So those are my 5 tips to have a successful 1031. Like I said, this isn't going to cover every scenario, but it kind of gives you a broad picture of what the process looks like. So Thomas, I'm going to turn it back over to you, young man.
Perfect. Excellent. Thank you so much, Dino. I appreciate
My pleasure.
I can't tell you, it's always so funny, the common sense stuff. But we do this every day and a lot of people have a lot of questions about it. But that I've had 2 clients over the past 2 years come to me and say, hey, I just closed on my place. I'd like to do a 1031. And you kind of just sit there like, what? You should have called me 2 months ago. So we cannot, express enough about how important it is. You can have a conversation even before you're thinking about selling, as long as everything's lined up. It's never too early to think about when to start a 1031 exchange. So thank you so much for all that information. Also, we always like to throw this in here. If you are a first-time investor or just looking to help get on the level of which we communicate about properties, you can download and check out the Reddick Property Rating ebook. We just like to throw that in there as well as the, hold on, let me go back there. Went one too quick. Any educational videos, articles, and guides. You can find those all on our website, marshallreddick.com/learn. You can also just go to the main MR website, pull down the Learn tab, and see all the stuff. Education, FAQ, connect with an advisor, and you can kind of like pin it down between videos, calculators, everything you could really be looking for. So it's a lot of information as well. So if you get a little overwhelmed in your search, feel free to give me a call, text, or email. Here's all my information here. Again, Realtor Advisor here at Marshall Real Estate, phone number, as well as my email address there. So marshallreddick.com/consultation. I'll go ahead and leave this information up here. But again, everybody, thank you so much for taking time out of your busy schedules to sit down with us and learn about some tax rules and laws on 1031 exchanges. So Dino, thanks. Everyone, thanks. And I look forward to helping you with your real estate investing goals. Have a great day.